Let me bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, good afternoon. Thank you for joining us. Now, tech funds have been top performers, understandably, over the last 2 years, heavily dependent on Infosys, all of them. The stock we know corrected heavily yesterday. What impact will that have on the returns of these funds? Is this something that worries you about these tech funds?
In fact, the big decline in the value of Infosys on a one-day basis is nothing new. In fact, it happens 5 times, at least 4 times in a year. And it is not unusual for Infosys to lose 6-8% in a day and also gain as much in a day. So the decline in value of Infosys has a bearing on the index, has a bearing on all funds, because there is hardly any fund which does not have Infosys. There are funds which may be underweight on Infosys, but I don't think there is any fund which will ignore Infosys or which will not have part of it. And I think that's exactly the reason why you choose a mutual fund, you diversify, and your diversified portfolio, a diversified portfolio of a mutual fund, where you have stocks like Infosys which go up and down by 6-8% in a day. And there are stocks which never go up and down, they have such wild moves. So, and overall, it provides you greater stability. So, I don't think, investors should really take note of this. Yes, if you have invested in Infosys directly, it can have an impact, but don't lose your perspective. There is nothing unusual about this 8% move.
But Dhirendra, you advise a lot of investors that the risk of investing in these sector-specific stocks is the fact that they're cyclical, and the funds will also be cyclical similarly. Now, would you now say this is the beginning of that downward cycle you've been warning about for a while?
Every component of the market is cyclical, and what we have seen in the last 3-4 years is the commodity companies, or a certain kind of company is completely ignored in the marketplace. They just don't get any attention. They have not generated any meaningful return. On the contrary, they have turned out to be a significant value component of this market. Look at all the infrastructure funds and their underlying investment. Look at all the public sector banks. Look at all the oil companies. So certainly, they look very compelling. They look very cheap. On the other hand, we have seen that consumer companies, pharma companies, as well as these export businesses, particularly technology, they have made huge gains, and in fact they have been able to withstand all kind of doomsday prediction. So but market is cyclical. We find that something which is ignored for a long time comes back. Something which was richly valued or was greatly attended to will go out of favor. And we will see this churn in the coming times. I think every variable is very well in place for this market to take notice of the ignored components. So I don't know about technology companies that whether they will go down in value or they will certainly stop going up. But Infosys kind of companies and all the leading tech companies, they are very hard to ignore, because I don't think their outlook has changed dramatically, or it is likely to get impacted negatively in any near term. Yes, there could be a rebalancing of the market's attention. Technology companies will lose attention, because if investors find that other part of the market is looking very attractive.
Well then, should we start exiting our tech fund holdings at this point, Dhirendra? Do you think that it's time to take the money that we've made over the last 2 years off the table?
Yes, you should not have any, for most investors, there is no role for a sector fund in their portfolio. So if you hold a couple of diversified equity fund, you can do without it, because your diversified equity fund will be holding anywhere between 15 to 25% into technology stocks anyway. So you can do without it. But just in case you wanted to emphasize technology, and you were looking forward to some specific some decent return, and you wanted to emphasize it in your portfolio, then it can well justify your holding even now.
All right, keep a close eye then on those technology funds, and of course we'll be tracking them for you on this segment. Let's take a few questions from our viewers. Well, Jay Chandra has written in, he wants to start investing in mutual funds for his children. He says he can put aside 2,000 rupees every month. He wants to know where he should be putting this money, Dhirendra. He does seem to have other investments going into ULIPs right now. He's also concerned about whether or not they're the most efficient investments to be putting his money in. What would you recommend he does?
There is a need to closely look at all your investment holistically. You have the insurance plan, which may not be adequate to cover your family, just in case there is a need. So I would say that go for an elaborate estimation of your term insurance requirement, and first buy that. That should be your first step. And rest of the money you are well taken care of with your term plan for the home loan. You are suggesting that it's from HDFC Bank, but banks do not issue, you only buy the policy from a bank, but this insurance policy will be by an insurance company. I think it will be important to take a stock of it. What exactly have you got? And after that, discontinue all your insurance policies and put all your money into our stable growth portfolio. That will be a very simple way, and that will, for somebody who has never invested in a market-linked investment, it will be an easy way to get started with your methodical investment.
Alright, so of course keep your term insurance policy right on top in any portfolio. We have another question from Dhyanraj, who's written in. He's a 29-year-old working as a software engineer. He started investing 4 years ago, Dhirendra. He's invested in 3 tax-saving mutual funds. He has the Franklin India Tax Shield, the ICICI Prudential Tax Saver, and the Axis Long-Term Equity. This is also a tax-saving plan, and these 3 are all your recommendations. He wants to now invest an additional 10 or 15,000 rupees every month in either an international fund or an aggressive fund in the Indian market. He wants to know what fund you would recommend he adds to his current portfolio.
As answered in the earlier 2 questions, that first go for an elaborate term cover. A lot of investors think that they have got an insurance policy and that will take care of itself. It will not be adequate for the kind of lifestyle and the kind of nuclear families that we have. I think the insurance cover needed for a family to be financially independent could be much larger than any of the endowment policies or the ULIPs can provide. So I would urge you to do that estimation and go for that elaborate term cover. Discontinue your ULIPs, and you have chosen excellent tax saving fund. If this is the only amount that you can invest, that is up to 1 lakh rupees every year, and you can't save any more, then these are the finest tax saving fund on which you will also be saving tax. So continue with this, and if you can invest more, then you can consider some fund from one of our 2 portfolios, which is the growth portfolio or the aggressive growth portfolio, given your long investment time frame.